ships cost $100 million. It's not like buying a car. It's very expensive. It's a long asset life. A lot of these new ships that are coming they can use two different kind of fuels. So traditional low sulfur bunker kind of fuel or diesel fuel, and then some sort of alternative. So we're not there yet in terms of what that alternative is going to be. And the industry wants to eventually get to zero emissions. I think that's a real lofty goal, and I think that goal is probably going to be pushed out further and further as the realities hit.
I think we've basically have passed peak production. Roughly 13.7 million barrels. We hit that in December. We're running somewhere around 13.4 million as of last week. So, operators are in this maintenance mode. They are investing to hold their cadence roughly flattish to slightly higher. And of course, when you take into consideration, you have a natural decline in a depleting commodity, we're sort of in that 13.4, 13.3 million barrel range.
And this was our view as well, that when OPEC meets on Sunday, they would decide on pausing their output hikes, because it's been 6 months that they've been increasing output. And the expectation was that in October, and probably for the rest of the year, they would pause these output hikes. But a couple of hours ago, there was a Reuters report saying that the group is actually considering another hike for October.
Does conversations around peak oil come into that at all, or is it full steam ahead from your perspective?
Yeah, it's a great question, because one of the things that the shipping industry is battling or trying to deal with is like, how do they become more fuel efficient? How do they lower their emissions? Obviously, if they all went back to using sails, that would fix the problem, but that's not reasonable. And the market doesn't really know what the alternative fuel is going to be winning. Is it green ammonia? Is it some sort of biofuel?
Good morning, good afternoon, everyone. This is Rob Barnett, and I would like to welcome you to today's BI Energy Exchange, where we talk about our research and the latest developments in energy markets. Today, we've got a special guest. We have Lee Klaskow joining us. He is our senior transportation and logistics analyst, joining us from Princeton, New Jersey. Also on the call today, we've got two regulars from the energy team. We've got Salih Elmaz joining from his usual perch over in Dubai, and we have Vince Piazza joining from, I believe, Wilmington today. So great to see all of you here. And Lee, I want to come to you first. We spend most of these calls really thinking about fun topics like the direction of crude oil and maybe the future of energy. But you really spend your time looking at the shipping market, the rail market, all sorts of things like that. And so I'm curious, as someone who's got some read across from things happening in energy land, if you can give us your framing, 30,000 foot, what's going on in your space that is relevant for the energy world right now?
Right. And thanks for having me, everybody. It's nice to be here. Nice to meet everybody that's online here. And Rob, when you said special, you should have done the air quotes for special guest. But anyway, so I am Bloomberg Intelligence Senior Freight Transportation Logistics Analyst. And I cover the energy markets from two sides. So energy is a big part of, what transportation companies haul. And it's also obviously a huge input to their costs. So I care about it from those two perspectives. And the cost of energy can have really huge ramifications, not only for profitability for a company, but for demand. So, the switch between trucking versus going on the rail, the lower the fuel prices, the diesel prices are, the better it is for trucking, and the more competitive they are with rails. From a kind of higher level demand side, The increase in production from OPEC Plus has obviously been a good thing for the tanker markets, because that just means they have more stuff to haul. And when there's demand increases, that is good. We look at the tanker market, it's broken up into two subsegments. There's the crude market, or the dirty market, as I like to call it, and then the clean market, or the products market, or refined market. The crude market is definitely in better shape, fundamentally speaking, and that's just because they have a lower order book, and supply growth is not expected to outpace demand, at least this year. Where the product market, you're seeing, the supply growth. When I say supply, talking about there's more ships coming online, because the order book is pretty robust, and that order book and supply growth is outpacing demand. So, when we're looking at the shipping markets, the crude market is probably the most favorable market that we look at. And in addition to tanker, we look at dry bulk and container liner. Container liner probably being the most challenged right now. But we're kind of, I would say, neutral to bullish on crude, and neutral to bearish probably on the other subsegments of shipping that we cover.
Maybe just a philosophical question. In your, I think it was your mid-year outlook, you do take a look at the supply-demand balance for crude tankers, and so you've got an outlook clearly for new vessels coming online, and it looks like you've had a surge in new capacity over the last couple of years, but it's perhaps a little bit more muted. At least it was in mid-year for kind of where things may be headed in 2025, 2026. So I'm curious, for you, when companies think about these sort of big decisions around investing in new ships, new capex there, do you ever hear conversations about the energy transition? Does conversations around peak oil come into that at all, or is it full steam ahead from your perspective?
Yeah, it's a great question, because one of the things that the shipping industry is battling or trying to deal with is, like, how do they become more fuel efficient? How do they lower their emissions? Obviously, if they all went back to using sails, that would fix the problem, but that's not reasonable. And the market doesn't really know what the alternative fuel is going to be winning. Is it green ammonia? Is it some sort of biofuel? They really haven't come to a conclusion of what's going to be used. And just because if I didn't plug it, I'd be a fool. I do host a podcast called Talking Transports, comes out every Tuesday morning. And if you go back and you see a couple of those episodes, we've done episodes with a lot of folks that run shipping companies. And most of them are taking a wait and see approach, as opposed to kind of being a leader in technology, because it's expensive. Ships cost $100 million. It's not like buying a car. It's very expensive. It's a long asset life. A lot of these new ships that are coming they can use two different kind of fuels. So traditional low sulfur bunker kind of fuel, or diesel fuel, and then some sort of alternative. So we're not there yet in terms of what that alternative is going to be. And the industry wants to eventually get to zero emissions. I think that's a real lofty goal, and I think that goal is probably going to be pushed out further and further as the realities hit. Because if you have a ship that costs 30% more, and your fuel costs 20%, 30% more, you're going to have to charge more. And then the person that's using that ship, that they have to kind of think, like, why am I doing this from an economic standpoint? They might be doing it from an ESG standpoint, but at the end of the day, you have to have profitability to be able to kind of support ESG mandates.
One more question before we get the rest of the crew in here to get some thoughts on things. I'm curious, just to follow up on that idea. For some time, especially over in Europe, there was discussion about moving more vessels to be LNG fueled, for instance. I'm not talking about the transport of LNG. I'm talking about running a vessel on LNG, perhaps to help with sulfur regulations, other things like that. Are you noticing any trends like that? Is that sort of a niche that sort of some companies in Europe are just focused on, or is it a broader global theme?
Well, like I mentioned earlier, they're all buying ships that can easily be turned on from alternative fuel like LNG. But we're not seeing them actually running on it.
Yeah.
So
Okay.
that's really a global thing, whether it's a European company like Maersk, or if you're in Asia, based out in Asia for like a Costco, they're all looking at it. They're not like buying, oh, we're just going to buy an LNG powered vessel. That they're just not doing that.
All right, and maybe okay. Given your opening remarks too, I want to just follow up maybe quickly on an idea that you mentioned at the start. So obviously, fuel is an input cost for your industry, and it's also something that you're hauling. So on net, when you think about oil prices, I mean, just looking at the screen here at the moment, Brent crude's about $67 and change. If prices go up, is that ultimately sort of a good thing or more of a cost hit? Um, I assume if prices are going up, there's some fundamental demand signals there in the background, that kind of thing. So how do you sort of balance what's happening in the crude market? Overall, higher prices are a negative or a positive from your perspective?
Yeah, so there's not an easy answer to that, because obviously, because first we have to figure out what's driving it. Is it what's driving the higher price? Is it a supply shock? Is it a demand shock? Obviously, a demand fueled increase in crude or oil or energy prices would be a good thing, because that means probably the economy is doing better. But if it has to do with something with supply, that could be a bad thing, because prices will still go up. And like for people like that are involved in the tanker market, that probably means that there's less stuff for them to haul, so their rates would be coming down. Um, Generally speaking, outside of the tanker industry, I would say higher fuel prices are a headwind for most of my companies, with some nuances built in there. Like, we're talking the competition between intermodal and truckload. I mean, diesel prices makes up around 20 to 22% of a trucker's costs. So, um, that can really impact a trucker's profitability, because most trucking companies are just owner operators, meaning it's just like a person with their truck and they're using an app and finding loads. And while those apps help them find the next load a lot easier, they're still driving empty miles. And if they're driving empty miles and fuel is $7 a gallon, it's not great versus if it's $3 a gallon.
Fascinating. Okay, Sally, let's swing over to you. Get your read on the crude market and perhaps some of the more downstream impacts. But give us your read here at the moment. You've got a number of notes framing out some scenarios, and you've highlighted a $50 bear case in recent weeks that you've put out. You've got a more bullish case as well, but what's the sort of base case in your view as you look into 4Q and into 2026?
Sure, thanks, Rob. A few things in there, but I'll try to kind of touch on all of them very briefly. So our fair value that I've talked about on this call a few times already is currently at around $67 a barrel. We've had this fair value for the last month or so. And our base case range that we also published on a couple of weeks ago is a range of $60 to $75 a barrel. And as you mentioned, in the last couple of weeks, we have been publishing a framework of scenarios where we started with our base case. We have a couple of scenarios on the downside. We have our kind of $50 to $60 a barrel looser fundamentals case that we published on. And then we have a severe downturn case where we see oil prices falling even below $50 a barrel. And then earlier this week, we published on what happens if fundamentals actually get tighter, in which case we see oil prices pushing above $75 a barrel. And what we haven't published on yet, but we will, and it will be the last piece of this scenario framework, will be the geopolitical shock one, which in June, the Israel-Iran war gave us a glimpse of. Intraday, oil prices went up by 12%. A lot of the escalation risk didn't materialize, but we think that we would probably, the only way to get to triple-digit oil prices at the moment wouldn't be through fundamentals, but would be through a geopolitical and supply shock. So that's generally the framework, some of the things that we already published and some things that we are planning to publish, and hopefully this will turn into a longer report in the next month or so. But a couple of comments also on oil prices and perhaps linking it back to OPEC that was mentioned earlier, because we do have an OPEC meeting coming up on Sunday. So earlier in the day, actually, morning time in Dubai, oil prices were closer to $69 a barrel. And I think there were a couple of drivers for keeping that support for oil prices. I think one was that US pressure that we've seen on India on their purchases of Russian oil. I think that's given a little bit of a premium on prices. Another one in the last few days has been the US moving some of its naval assets near Venezuela. I think that was to push against drug trafficking. Perhaps not too much of a premium, but it seems like this has given some premium to prices. But also, I think one of the drivers was a general expectation in the market, and this was our view as well, that when OPEC meets on Sunday, they would decide on pausing their output hikes, because it's been 6 months that they've been increasing output. And the expectation was that in October, and probably for the rest of the year, they would pause these output hikes. But a couple of hours ago, there was a Reuters report saying that the group is actually considering another hike for October. So I think that 2% drop that we've seen throughout today, Brent going from 69 down to $67 a barrel, is being driven by these reports that, we don't know what the decision will be, but it sounds like some insiders are saying that the group is considering another hike for October, which I think would kind of cement that view that the group is really serious about grabbing market share back, and then really seriously moving away from the strategy of supporting prices as high as possible, even though the outlook for the oil market, for the crude oil market in the fourth quarter, is currently for a sizable oversupply, for a sizable market surplus. So knowing that, still bringing more supply into the market where demand signals are still very mixed and very fragile, and non-OPEC plus supply is still growing, would would exacerbate the downside catalysts for oil prices.
Very interesting, Saleh. Thank you for the very interesting comments there on OPEC. Just a quick bit of marketing. Most of you listening are in one or both of our client chats for energy. We've got the BI Energy Exchange and the BI Future of Energy chat. Lee, I'm just curious. I know you mentioned that you do a weekly podcast. Do you also have a client chat that folks could join if they are interested in a more transport angle on things? And I also think you've got an event coming up in London, if you want to give the details on that quickly as well.
Yeah, sure. We do have something we call the Logistics Lounge. It's an anonymous chat available to Bloomberg customers. So you can access that if you just go to BI Go on the red bar, you can see our chats, and you can sign up for the various chats that we have. Also hosting an event in our London office on September 16th. It's a shipping event. We are going to we're going to have the president of Scorpio Tankers there for a fireside chat, which I think this group would be most interested in. We're also having the president of Starbulk, Hamish Norton. That's a dry bulk operator. So for those that are interested in coal, that might be an interesting conversation. We're also having a bunch of sell side analysts panels, economists, and credit analysts to give their perspective on the shipping market. So it should be great. And best of all, it's going to be followed by cocktails. So hopefully, if you show up, I'll get a chance to meet you all, and it will provide some networking opportunities as well.
Thank you, Lee. So that's September 16th in London. Vince, let's get you into the conversation. Solly was just talking about OPEC plus and perhaps a desire to boost market share. What's your read here at the moment on what's going on in the shale patch in the U.S.? Have we hit peak production? Do you anticipate declines? Would it be easy for OPEC plus to grab market share? And what would that mean for prices in your view?
So yes, I think we've basically have passed peak production. Roughly 13.7 million barrels. We hit that in December. We're running somewhere around 13.4 million as of last week. So, operators are in this maintenance mode. They are investing to hold their cadence roughly flattish to slightly higher. And of course, when you take into consideration, you have a natural decline in a depleting commodity. We're sort of in that 13.4, 13.3 million barrel range. Prices here somewhere in the low 60s. I think that's pretty much a relative sweet spot. If you think about it from a demand perspective, we look at two things, right? Downstream, we look at total product supplied, and that's our proxy for demand. That takes in to all of the things that Lee mentioned, whether it's on-road diesel, on-road passenger vehicles, all forms of transportation, and total product supplied is running somewhere around 2.5% year over year on a 4-week rolling basis. So it's fairly healthy even at this point. Again, we are past the summer driving season, so we should see some of that lag effect, but we're likely going to come on down a bit as we push past that demand peak on the crude side, so more on the upstream side. Days to cover, which is another proxy for demand. It's roughly running 24, 25 days, and that is still somewhat above where we were last year, and so that's relatively positive as well. I think we're in this point where we have the geopolitical side that Saleh mentioned, and that's causing a little bit of a clouded backdrop for many management teams, not wanting to get too ahead of the curve here. The curve in general is in backwardation. So we have seen sort of a pause in the M&A cycle. And that seems to be fine at the moment. And so capital allocation seems to have curtailed, even capital allocation within the companies itself. So you're not seeing a great deal of capital commitment to growth, and that's fine. That's what the investors want. They want that excess capital back in their hands via dividends, supplemental dividends, and also some amount of buyback, although the buyback piece has slowed somewhat in the first half of 2025. In general, what has led this market, it really has been the M&A side of the house. And we have seen that of late sort of quiet down a bit. We have had 1 and 2 deals in the last couple of months, but nothing that is earth-shattering. We still think there is a great deal of consolidation that needs to be done in our space. Again, with the civic backlash against legacy energy, and energy itself coming up to sort of what I see as a maturation within the overall cycle. You mentioned shale. I think we're past that shale growth stage. And for the last several years, we've been in this maturation phase where consolidation to gain scale has been paramount. And that has led us to create, and I think Robbie wanted to mention this, but I'll mention it myself. We have created an M&A database, and this is a very unique data set. It's not just a corporate M&A, but it's also asset-based M&A. We've rolled this out last week. It is upstream focused for now, upstream focused in the US, but we're going to roll that out across all the regions of the BI ecosystem. And we're also going to roll that out across the other spaces that we cover here on the global energy team. So we're pretty psyched about rolling this out. This is a very unique database. It shows the assets being purchased, and also it highlights the metrics behind the upstream specific deals. So if you're buying acreage, if you're buying reserves, and if you're buying actual production, we give the investors, BI customers, an opportunity to export all of that data and manipulate it as you guys see fit to create your own analytical framework. You could use ours, which is a pretty standard default, but you could also download all of that information and create your own analytical framework.
Thank you, Vince. We will make sure to share the link to that very cool new database that you've been working on when we share the replay. I'm curious to follow up on an idea that Lee was mentioning with and tie it into crude by rail. So if you look at various times over the last couple of decades, you've had some points where you've had some pretty substantive crude by rail shipments. Looks like it's undulating at kind of 10,000 barrels a month or right now, roughly. So it's not a very significant part of the overall mix of flows here in the U.S. But Vince, are there markets in your mind that are constrained in terms of development because they don't have enough pipeline capacity and therefore might be turning to crude by rail? And as you kind of think about the next 12, 18 months?
Less so today than, say, several years ago. As Lee may mention, as Lee may remember, not long ago, the Northwest Pacific market was capacity constrained. I'm specifically referring to the Williston Basin. Bakken crude was regionally constrained, and a lot of that needed to be moved by rail. And you saw that basis blow out because of it. In various times, it was anywhere between $5 to $10 a barrel to ship that product out. Profitable for the rails, not as profitable for the extractors, but it was needed because of the constraints on the pipelines. But now, because of growth overall has been constrained, we don't have that as much on the crude side. Where we are seeing the pipeline constraints is really on the natural gas side, especially out in Texas. Associated gas in Texas is massive. It is the second largest natural gas region in the country. And we've had basis blowouts in the past. We even had negative pricing at the Waha hub for a while. That has since recovered, but is still significantly below where we are at Henry Hub, and that's because Matterhorn has filled up pretty quick, and that was roughly 3 BCF a day. So, if anything, it's on the natural gas side that we see the constraints. Of course, that will improve over time, but it's good to see that we don't have those same issues on the crude side, at least not as significant as from several years ago.
Lee, is there an angle on the gas market and rail if you have these kinds of setups that Vince was describing? Oh, you're muted, Lee.
Sorry, rookie mistake. So yeah, so for the rail industry, crude by rail and any other related products that they're able to ship is good. The problem is it's never consistent for them because usually they're the they're, as Vince mentioned, are used when the pipelines can't handle it, or if just prices are really, really high. And we've seen some surges in demand in 2007, 2008, also 2012. And I'm cheating right now. I'm looking at a great chart on the Bloomberg terminal, so you should check that out. We have data from AAR, and what they kind of learned from those lessons is when it peaked and when it fell down, they rushed and brought a lot of resources to bear to kind of take advantage of it, and then the demand just dried up, and they took resources for crude by rail and others at the expense of other customers, and they realized that probably wasn't a good idea. So they'll take it if they can do it, but they're not going to like bend over backwards to get the additional volumes. And it's good
Lee, I
for
want
them,
to.
like especially with the fracking, is bringing stuff into the wells, like whether it's sand, water, pipe. That's probably a better market for railroads. So when you see increased fracking, that's a good thing for the rails.
Lee, I want to shift back to the marine side of the equation. Uh, Do you hear much about the Jones Act these days? It's a common theme here for the energy segment, thinking about crude flows within the U.S.
Yeah, I don't focus that much on the Jones Act because most of the companies that are Jones Act are very small market caps, and so they don't get a lot of investor and customer interest. We usually focus on the much larger companies that play in the global markets. Some would argue that it's an antiquated system. Some would argue that it makes sense to keep on going because you never know when we're going to be at war next time or with who. And I can see both sides of the argument.
Very diplomatic. Maybe to to bring in geopolitics just a little bit again. Solly mentioned one of his more robust pricing scenarios involving some geopolitical concerns, and maybe 2 or 3 months ago, we were spending a lot of time talking about tensions in the Middle East, the Strait of Hormuz. I imagine that a number of the companies you cover have vessels that may transit through that region of the world. And are there any special considerations you think about when you think about shipping logistics and the potential tensions that could flare up again in the Middle East?
Sure. So one of the biggest headwinds to rates, and whether it's tanker, dry bulk, or container liner rates, is once the Suez Canal is fully opened. There are ships that are traversing through it. Most of them have some sort of a relationship with China, Iran, or Russia. So those ships usually aren't getting hit by Houthi missiles. But most other ships are avoiding it at all costs, or companies are avoiding it. And that adds around 10 to 15 days of travel time to go around Africa, and that has sucked up a lot of capacity out of the market. And once the Suez Canal is opened up, it's really going to negatively impact rates. And I mentioned earlier, like the liner market, we've seen rates consistently going down. So we think that is something that we're watching carefully. Unfortunately, we don't think that's going to happen anytime soon, because obviously once it happens, that means there's better chance for peace in the Middle East.
Solly, we're going to come back to you, and we're going to wrap it up here in just a second. But give us your sort of read into 2026 on geopolitics, and when you kind of look at the current price, do you have can you sort of gauge it about how much geopolitical risk premium is currently baked into the market, and what is the sort of high end of how much geopolitical risk could enter the market in your view?
So short answer is that no, I can't gauge how much geopolitical risk premium there is. I wish I could, but we generally try to um, give some color on how much of premium might be baked into prices. Currently, my guess would be that it is less than $5 a barrel. But this is one of the questions that we love asking in our surveys. Speaking of which, we will be running another BI survey where we will have this question on there. So it's not ready. We don't have the link yet, but probably next week, if I join the call again, I will have a link for everyone to take that survey for us. And it's generally one of the questions that we ask people just to get a sentiment about what the market and our clients think where the geopolitical risk premium is. And I would say a couple of months ago when we were talking about geopolitics, we were predominantly talking about the Middle East. As I mentioned earlier, now when I brought up geopolitics and what might be bringing a little bit of a premium to prices, has been more kind of the Russia-India story, as well as the U.S. naval assets being near Venezuela. So surprisingly, it's not. Perhaps surprisingly to some, it's not always the Middle East. It's almost always the Middle East when we talk about geopolitics. Looking at 2026, I mean, we really there has been a temporary ceasefire, and as I mentioned earlier, the escalation scenarios that we talked about in June didn't really materialize. The scenarios where we talked about how oil prices could shoot up to triple digits didn't materialize. But that's not to say, and these ceasefires can be quite fragile, especially in this region. We really can't rule out further escalation looking at 2026. Obviously, we don't know, huge uncertainty. But again, as I mentioned earlier, it is in our scenario framework. We are still talking about that tail risk, that low probability but high impact geopolitical shock scenario, which doesn't have to be from the Middle East, but generally when we talk about geopolitics, we do talk about the Middle East. So long-winded answer to your question, but it's very difficult to gauge. It's a moving target to try to gauge geopolitical risk premium. I personally think that it's not a lot right now. It's less than $5 a barrel. But for the next year, we really can't rule out further geopolitical escalations that could bring a bigger premium to prices.
Okay, thank you very much, Salih. We will make sure to share the link for the survey that Salih mentioned. We want to know what you think. I've seen the questions we're answering, a lot of good ones. Can't wait to see what everyone thinks, and we will certainly be sharing the results once we close that out. So stay tuned for that. We're coming very soon. Let's close out with some big picture thinking here. So one, if you haven't seen it, Patricio and I have been rolling out a pretty cool series of notes on the intersection of AI and energy demand. If you're not following that, very hot topic, a lot of angles to think about, whether you're thinking about the gas side of the equation, what it could mean for solar and storage, or even nuclear. Make sure to read all the flow we've got on that. Very fun, and happy to have a conversation specifically on that topic with you if you'd like follow-up. So Lee, I want to come to you, and we're going to just do a quick round robin here. But as you look into 4Q, and you think about the space that you spend all your time thinking about, what do you think is the biggest idea that you believe is true that's maybe not appreciated in the market right now?
Wow, it's
sorry to put you on the spot.
That's a really deep question. So I guess I am. Maybe it is appreciated by the market. I don't know, but like what I would say going into the fourth quarter, I'm betting against the consumer, and that's something I don't think I've ever said before publicly, because usually I'm a perma bull. I'm a half, a glass half full kind of guy, and It's usually filled with a lovely California cab. And, but like looking at the impact of the tariffs, which obviously is my world, um, it really hasn't hit the consumer yet. And the consumer is just going to, they might be spending the same amount of money, but they're going to be buying less stuff. And I just care about the movement of stuff. I do like people, but I more care about things when it comes to, covering the freight markets. So I just think that the demand is not going to be as good because you have a consumer that um, might not be able to buy as much things, and also, inventories could be a little bloated because of the pull forward effect that a lot of shippers did in the first half to get ahead of tariffs. So that's, I guess, what I would say. So I guess if you want to have me on in January, we can see if I'm right or if I'm just, a knucklehead.
All right, that's great. That's very vibes of Mike McGlone. He's been saying things like that for a little while now. For anyone who's a regular on this call, you'll heard Mike say similar things. Vince, let's hit you up. Same question. 4Q is when you got your crystal ball. What are you looking at that you think is very prescient, but the market might not quite be grasping here at the moment?
So if I look here at the NYMEX Henry Hub 4Q25, 384 on nat gas. That seems to be the price. But the way I think about things, we're on a record as saying closer to 450 to 5 on a tighter balances for the winter season, and I think that's what we're going to stay with for now. We have a focus idea out on this. Take a look at it on the dashboard, but I think the market's underappreciating the tightness that we'll see in winter draw season.
Fantastic. For anyone who doesn't know it, you can find all of our focus ideas by typing BI space focus. Energy all across all sectors and on down the line. You can check it out. Solly, over to you. We'll give you the last word. What are you looking at for 4Q that you're excited about, but you don't think it's quite reflected there in the market here at the moment?
Yeah, I would say our balances are pointing to a very significant surplus that I alluded to earlier on. It's not as big as the IEA numbers, but it's still pretty big, which would make you think that oil prices would be under a little bit more pressure than they have been. But I think if this materializes, I mean, of course, there's a lot of uncertainties, but if we do have visible inventory drawdowns going into the fourth quarter, I think that will become more apparent. And it will be reflected in prices. Again, I mean, our base case is still the range of $60 to $75 a barrel, but generally in our scenario framework, we are giving a higher probability for the lower price scenarios than the higher ones. So watching that surplus building very closely, and I think if it does materialize as us and most of the rest of the street expects, I think there will be a lot more pressure on prices.
Okay, very interesting. Lee, what's the best way to access your dashboard? For oil, we've got BI, OPEC, we've got numerous dashboards, but what about where can clients find your content?
Yeah, so we have 4 freight transportation logistics dashboards. One is BI space SHIP as in Peter, BI space RAIL, BI space TRCK, BI space 3PLS. 3PL, yeah, 3PLS. That last one is logistics and parcels. The other ones should make sense to everybody, but the other one is logistics and parcels. So that's third-party logistics providers.
Fantastic. There will be a quiz. For anyone who uses the Bloomberg terminal, there's all these mnemonics. You got to keep them in mind. You can also create bookmarks for these dashboards as well, so you don't necessarily have to remember the nomenclature. But we will follow up with some of the links from the topics we discussed today And we look forward to being in touch. We especially hope that you will take our client survey once it is out, and Solly and I will be in touch with that with the group here. So take care, everyone. We hold these calls every Wednesday at 10 a.m. New York. So look forward to seeing you next week. Cheers.